All right, so you are welcome to the part two of the performance management aspect of the management accounting performance measurements course. Now, here with part two, we are looking at divisional performance measurement. Do you remember when you were doing things like departmental accounting, whereby one department will produce something, probably the other department is responsible for selling it, all right? Each department has something to do, right? So here we are looking at the concept of divisionalization, all right? So you see that in this one, the concept of divisionalization is trying to tell you that we have situation whereby business areas are given certain degree of autonomy. So there are some segments, all right, or let's say departments, all right, of a business, and the managers involved over there are given certain degree of autonomy, all right. So they have some sort of some sort of autonomy over decision making, all right. So we are looking at systems whereby they actually departmentalize the company so that every manager in each department is given a degree of autonomy. So he will be responsible for everything that is happening, all right, inside that department, all right. So basically that is that in terms of decision. Okay, so basically saying that they have the authority actually to do anything without making reference to any senior manager or anything like that. So because of that, you are kind of allowed to be given the opportunity to run your own part of the business. It's like you are in charge. All right. So basically that is that. And so we will have to also measure your performance to that effect. All right. Of course, there what you need to understand is that that thing that happens has some advantages. Okay, so that departmentalization, it's like having companies that have branches. Okay, so what happens is that it gives some level of specialization. All right, so we have some level of specialization. Every day when you come, your department has the greater thing that they will do. And the managers are motivated because you feel like you are leading a group of people. All right, so basically that is that. Now, you are allowed to determine or measure your own profitability. So this system allows divisions to be profit centers. Okay, it allows divisions to be what? Profit centers. Profit centers. And if you are like that, that alone is motivating. It's motivating, and it promotes efficiency because you know that my department is contributing to the total profit of the business. All right. So that is that. And so because of that too, the entity is able to do comparative. So you're able to compare performance. All right. You are able to compare performance between departments, performances between departments. Right. So these are things that happen. All right. These are things that happen. And because you are alone in your own department and these things that are happening, it's actually a promotional thing for decentralization, whereby everybody gets to do something meaningful. All right. So basically, that is that. Because you have clearer objectives and you know what you are working on. Okay. But of course, everything that has advantages also has disadvantages. It's very interesting. So there is no perfection. It also has disadvantage. The disadvantage is that because it is competing, departments are competing. If you don't take care, what will actually happen is that you will be having issues of lack of goal congruence. People are not focusing on the major budget line. They are just competing themselves. All right. And that one will lead to that is what we call lack of goal congruence. Goal congruence simply means a situation whereby everybody is feeding his or activity into the main budget for the entity, all right, the common good of the entity. But if everybody is looking at themselves because there is some sort of competition, it doesn't really help. All right. So that is that. So if you don't take care to it, will lead to duplication of services. People will be doing the same thing, but it's just that it is departmentalized. All right. So it can lead to that. And there is difficulty in fair comparison because people are not doing the same thing. Now that you want to compare departments' activity, they are not the same. It's like comparing Messi to Ronaldo. They are not the same. They don't play the same position, but we keep comparing them. So basically, that is that. There are difficulty in fair comparisons. All right. And it also makes coordination very difficult. Coordination very difficult. And lastly, something that uh, we will look at later is it creates what we call transfer prices, which I will explain later. All right. So basically, that is that. That is that. But the key principle about divisional performance is that management should only be assessed based on the factors they can control. If the thing is outside their control, then you shouldn't, judge them by it. All right. Because some departments, as you get to know, are cost centers. When we say cost centers, what does it mean? It simply means that they are there to generate costs. They don't generate any revenue. They are just people who incur costs. They don't generate revenue. No revenue whatsoever. They are not meant for generating revenue. They are just there to incur costs. That is what they do. That is what they do. All right. So you see that if you are measuring them, determining whether they are doing well or not, you should be looking at their cost variances. Cost variances. If you have a transportation department, a department that is whose job is that they pick staff from their home to the workplace and from the workplace to their home. That transport department doesn't generate any revenue whatsoever. They are just always incurring repairs and maintenance on the cars or the buses they are using and fuel. All right. So if you want to judge them, you must use something more of cost variances. All right. Or something like um, in terms of quality in productivity. So you'll be also measuring them in terms of their efficiency. All right. So basically, that is that. Okay. Or cost per unit, sort of how much they contribute to cost in terms of this. So these are cost centers. But we also have revenue centers. Revenue centers. These revenue centers in your entity, all right, like the selling people, all that they are doing is that they sell the thing. Okay. So they only generate revenue. They only generate revenue only. All right. They only generate revenue. So for them, all that they are doing is that more revenue is coming into the company. So if you want to measure these people, first of all, customer satisfaction. All right. Are they giving the customer satisfaction? And again, because it's all about selling, total sales is one of them. So here we are looking at what? Sales variances, total sales or market share. So if you have you are like uh, an entity, look at these departments. How much are they contributing? All right, in terms of the budgeted sales that you decided to do. These are revenue centers. You have to, measure them, their KPIs according to these kind of things. Let me ask you, you that is learning accounting in your office, your account department is a cost generating unit, a cost center, right? All right. So because we don't go out to bring money, but we make money. Sometimes we are profit centers. Why are we profit centers? Because we do investment. We invest excess cash. All right. So sometimes in our KPIs, there is a little of how much we can also add to the profitability of the entity. These profit centers incur costs, but they also obtain revenue. Just that they cannot decide on investment. All right. They cannot decide on investment. Okay. So here, if you want to measure us, you can combine the two here. All right. To measure them because they have cost, they also have revenue. So you'll be looking at profitability. Okay. Then we have the last one, which is the investment centers. Investment centers. So you see here, they incur cost revenue. They are not allowed to make investment decisions. But here, the only difference between investment centers and profit centers is that they make investment decisions. So here, they incur costs. They also generate revenue, but the manager has the authority to actually make investment. So they have authority over investments. All right, so that is that. So this is where we will be focusing on the more, because here, when you are measuring their KPI, what will happen is that you have to measure all the measures of profitability. These ones, cost, they are the same, profitability the same, you measure them. But you have to also measure for them ROI, return on investment, and RI, residual income. All right. So that is that. But we are going to go into it with extra ratio of EVA. All right. Economic value added. All right. So we are going to do that. All right. So that is it. So let's look at these ones into detail. All right. Let's look at them into detail. Now, so we are going to take the first one, return on investment. Return on investment. So you clearly see that this is a ratio that is evaluating an investment decision of a department. So it is solely for investment centers. So we are looking at the ROI. All right. It evaluates the investment decisions of the department. Okay. It is similar to the ROSI that we did in the part one video. But so here the formula is that your ROI, which is your return on investment, is equal to controllable profit. Controllable profit. I hope you remember controllable profit all over capital employed. So what is controllable profit? Controllable profit is the profit after depreciation but before tax. Before tax. That is what we mean by controllable profit. All right. So basically that is that. Profit after depreciation. So by extension, what we are trying to mean is that controllable profit, of course, we said but before tax, because tax are uncontrollable. Why? Because tax are determined by external factors, government regulations, which you don't have control over. The government can say it's increasing tax rate from 25% to 30%. There is nothing that you can do. So when you look at this one, we are looking at the controllable sales because variable cost. Sales depends on how much you can sell. All right. So sales. All right. Then we have here depreciation is a fixed cost, so it's part. So here, the cost that we are talking about, which is your controllable cost, we are looking at your variable cost plus your fixed cost. All right. So basically, that is what we are talking about. So when you take all of them out, then you will have your controllable profit. So basically, that is what we are talking about. Now, be careful because when you are also talking about this profit that we are trying to interpret, this raw E that we are trying to interpret, you could also say that the formula we are looking at is, so here you can say net profit before tax. Okay, I think that makes sense. All right, so this one is also called net profit before tax. Net profits before what? Tax. All right. So basically, that is that. Now, alternatively, you must understand that this controllable profit that we are talking about is also looking at all gains from investment, all the gains that are from investment. So every investment gain that you get, all right. So we are looking at the profits you derive from the investment. Okay, so basically that is that. The total profit you are getting from the investment. So basically, that is the portion that you must understand. Now, if you have a question, all right, and in the question you are provided profit figures, use that one, all right. You assume that that is the controllable profit, unless the question tells you otherwise, all right. So if you have the profit given in the question, you take that one as such. But let's look at your capital employed. What is capital employed? We explained capital employed in the first video, where we said capital employed is total assets. And when we say total assets, we mean your non-current assets plus your current assets. All right. Then you take away your current liability. Okay. So that is what we call capital employed. Capital employed. So that's one way of getting your capital employed. Alternatively, you can also use what we call the equity side of your balance sheet. We call it the shareholders fund. The shareholders fund. That one includes your stated capital, your share premium, your capital surplus and income surplus or revaluation reserve. Okay. All right. So these are all your capital surplus plus interest bearing debt. Interest bearing debt. All right, which is usually your non-current liabilities. All right, so basically that is that. Interest bearing debt, like the debt that had percentages in front of the 10% loan note, debenture loan, or 15% days and all those things. So those ones are your capital employed. Alternatively, the question can give you the cost of the investment. The cost of the investment that you made. All right. So basically, that is that. That is that. Now remember, this asset, it can be at replacement cost, can be at historical cost, it can be at replacement cost. You learn these things in public sector, right? It can also be at the net book value, or even be at realizable cost. So look at the name or the note that will be attached to the asset. All right. So basically that is that. So these are the details about the formulas, the formula that you need to know. Now, what you need to understand is that what is the interpretation of what you will get? When you use your ROI, what is the interpretation? Now, if your answer that you get is positive, if the ROI is positive, what it means is that the investment is what? Profitable. the investment is profitable investment. All right, so that is that. Guess what? For negative, when it is negative, it means what? It is unprofitable. It is a loss making. All right, it's loss making. Okay, what if it is zero? Zero means it is a break-even one. So whenever you have a break-even, you must look at other non-financial measures to evaluate the project. All right, so basically that is that. Now with all these things that we have done, the best thing is to actually take a question and do. But the importance of the controllable profit here is that it is for performance evaluation, decision making, and motivation. Basically, that is that. All right. So please bear in mind that you are looking at issues like this. Your controllable costs. Remember, I said that the controllable profit, this one, is given by controllable sales. So that is it, controllable sales. And sales is always controllable because you determine how much you want to sell. But the controllable cost that you deduct, it is your variable cost. What are your variable costs? Remember direct material, remember direct labor, all right, and overheads. Okay, so those are the things like your overheads, like marketing expense, rent expense. But please, what you need to understand is that if the rent expense is predetermined, it is not controllable because you came to meet it. So please, uncontrollable expenses, which you have to exclude from the profit determination, will include, as usual, I've already mentioned, taxes, right? Interest expense is uncontrollable. So that is why we need to stick to the profit after depreciation by before tax. But so if you have a finance cost inside it, remember it is not controllable. All right. And even rent and lease expenses, which is already what? Predetermined. Because if it is predetermined, I mean, there is nothing you can do about it. All those ones too are not what do we call it? Controllable. All right. So please take note of that. Take note of that. All right. So this is it. What best to do and to take a question and deal with that. So let's take our first question to practice. Okay. So we have a question in front of us. Let me make sure you have full view of that. Okay. It says that there is a division of Spencer Group, and the division is Division A. So it said Division A of Spencer Group has investment at the year end 56 million. These include cost of new equipment item costing 3 million. That was acquired 2 weeks ago before the end of the year. Good. This thing has an implication because what you need to understand is that the timing of your asset also has implication because what it does is that the impact of the asset towards the contribution of profit will be low. For example, let's talk about timing of asset. It's very important before we even try solving the questions. Because here, the capital employed, remember we said is the total asset. Now, what you need to understand, this is simple analogy. If my financial year end 31st December, let's say 2026, okay, we are in 2025, right? So let's say 2025. Now watch this. If I buy an asset on 15th December, what impact, how much can the asset generate for me as compared to an asset that I bought on 1st January 2025? you see that this one will have a lesser impact because we just bought it. All right. So preferably, when it comes to the timing of asset values, we are going to be relying on averages. Okay. So we are going to be relying on averages. Anyway, in the exams, use provided figures, whether average or the asset at the period end. So take note of that. Take note of that. In the exam, please use provided figures, whether it is average or it is end of year figures. Okay, so that is that. So that is just to explain something to you. So they bought it 2 weeks ago. It was 3 million, and it says that the equipment was paid for by the Central Treasury Department of Bobage. Okay, so let's say Central Department of Spencer. Okay, so that is that. Then let's continue with the statement that the profit, okay, so, and it is recorded in the accounts of the as an intercompany loan. That's fine. That's fine. The profit of the Division A for the year was 7 million before deducting head office charges of 800. All right, 800,000. Now, what is the most appropriate measure of ROI, okay, for the Division A? Now, the issue here is that because the value of the asset is 56. The value of the asset is 56. So asset value 56. 56. All right. Now the argument is that the asset that was bought 2 weeks ago, what impact has it got to contribute to the value of the profitability? So this is what you can do. Now the question is asking you, what is the appropriate measure of ROI? Now the question is, do you believe that the asset that was bought 2 weeks ago could contribute to any profit that the company made? So that is a question you need to ask yourself. So if you want to really measure that thing, you can say that you will deduct 3 from it. That is one way of doing it. So here you have 53. Don't panic. Don't panic. All right. You can also say, like I said, in the exams, you can use the end of year figures that you have. So here you can say that whether the asset was bought, whether in 2 weeks ago or not, it still produced something. 56, we can use the 56. All right. So we can use the 53 plus that 3, which is the 56. Alternatively, one could also say that, okay, can I find an average of that? I mean, because everything was not from the beginning of the year, can I do an average of that? So somebody can decide to say, I'm weighting the thing on average basis because this asset was not there for the full 12 months of the year. Okay, so if you get a situation where the asset, so if 50 the asset 53 was, you were given a date for that, you will weight it over the days and find out. All right, so you will say that 53 lasted for 10 days, so you multiply it by 10. This one lasted for 14 days, you multiply it, then you divide it all over the days. So for example, let's say the 53 was there for the whole year and there are 52 weeks in a year. So one can say that the 53 asset, maybe if it was there from the beginning of the year, that one was there for what do we call it? 50 weeks. All right. Plus the 3 assets, the 3 one that also lasted for how many weeks? 2 weeks. Okay. All over the number of weeks that we are talking about here, which is 52 weeks. Okay, so basically that is that. So you are looking at a situation whereby you have 53 multiplying 50. Okay, that gives you something like this, 2,650 plus this one that is giving you 6. All right. So at the end of the day, you divide it all over 52 weeks, and that is going to give me 51. So instead of using 53 or 50 this thing, you are going to use 51 days. All right. So if you get that, okay, now you have your controllable profit. So the controllable profit, according to the question, is I told you that one. If you also have the profit, you can use. You have 7 million, but we said that it is profit what before fixed costs like depreciation, like of head office charges. They are fixed costs. They are part of the costs. All right. So profit after depreciation. Okay. So we are looking at profit after depreciation, but minus what? Uh, cost that is uncontrolled. Now, the head office is charging 800,000. This is internal, company. Now, should we deduct the 800 because the thing was before deducting the office charges? It is a fixed cost here, but it is already predetermined. So the head office is just taking the money. Do you control it? You, the manager of that division, do you have a control of it? No. So it is predetermined. All predetermined expenses, fixed, all predetermined fixed expenses. Like I told you, for example, rent, when it is predetermined, it is not part. A typical example is this one. It is already predetermined. So if it was already deducted, we would have taken it out because it shouldn't be part of it. So if this thing was like after deducting, which means that they reduced our profit, but we'll go back and take it out, which means that we will add it back. That is the meaning. So, for example, if they had said that it is 6.2 because they had already deducted the 0.8, which is the 8, all right, here, we would have gone and added back so that we can get. Why are we adding it back? We are adding it back because that thing is not controllable. Somebody just, an external factor just pinned it on us. All right. It is predetermined. And so that is what happened. All right. So here our controllable profit is just the 7. You must understand that bit very well. Okay. You must understand that. So now that our controllable profit is 7, what do? Our ROI can be in 3 forms, right? So we can have the 7 million dividing 53 million. And don't forget, everything is 100%. Okay, so it's 100%. Or you can have your 7 million over 56. Don't forget, these are in cedis. Or you can have the average, which is, but you see, the thing is that they never told us the timing of the 53. I'll just use this as an example, all right, because they mentioned 2 weeks. Okay, so or you can do 7 million over 51. So which of them, what would our answers be? Of course, you see this one here. So this one is 13.2. Now, if you had used the 51 divided by 7 by 51, that one would have given us 13 point multiplied by 100%. 51. Hold on. Maybe I'm not punching it well. Yeah. So the next one is 7 million over 56. This one is 12.5%. Then 7 million over 51. This is 13.72. All right, in terms of percentages. Okay, so That is that. Okay. So which one is the best for this? For now, I think that this one is the best because you weighted it. All right, because you did a weighted average for it. But because we didn't have these in terms of how many period the 53 was there for, we can now say that we are sticking to this because the question is that the asset that was bought 2 weeks ago, they didn't make any impact in generating profit for us. So that is the kind of analysis that you have to go by. All right. So you can have various answers, but which is the most appropriate is the most important thing. I hope now you get the vibe of it. So let's look at this question too. Okay. Let's look at this question too. So you have, I told you the asset has values. All right. We have net book value, we have realizable values, we have replacement cost and everything. You use the one the question talks about. All right. So here you see your assets. The investment center's profit is 28 million. So you have your 28. All right. So that means that your controllable profit. But if something was not done to it, you have to do it. Okay. So your controllable profit has been given to you. You have 28,000. Good. And it has the following assets and liabilities. Okay. So the net book values are there, then the trade payables are there. Do you remember what we learned? That the capital employed that you divide the thing by is total asset minus current liability. So you see your assets, okay, and this is your capital employed. The question will not tell you, but you have to know. So it is total asset. If you add all your total asset, you take away your current liability, which is your trade payable. That is what you get. And therefore, this one will be dividing it by your 142,000. Of course, since you want it in percentages, you have to do by 100%. All right. And so you have 28 by 142, 28 divided by 142. And that gives me approximately a 20%. All right. So, ladies and gentlemen, that is it. All right. Now, however, you must understand in this same kind of questions that if the manager has no responsibility for debt collection, it is not the responsibility of the manager to be collecting the debt, then you must understand that your capital employed will change because it is not the responsibility of the manager to be going out there to be collecting debt. I mean, your receivables. Okay, I think my internet is having a problem. Okay, I think it's back now. So if it is not the responsibility of your manager to be going out there to collect debts, then it means that the trade receivables is out of his control. It will be out of his control. And therefore, you have to deduct the trade receivable from the 142. And so therefore, in that particular case, your figure here will be 28,000. Taking away the 30,000 out of this, you will have 112. And in that case, what would your answer be? So you have to understand that we are doing some things about the things the person can control. Okay, so read the story well. All right. So if he's not the one in charge of collecting the receivables, or he's not the one in charge of doing anything within the figures, then it means that in this case it will be 28 over 112, and therefore you can measure him and say it is 25%. All right. So I hope you get the controlling and the non-controlling part. It's very, very important. All right. So basically, that is that. All right. So theoretically, what you need to do is to get some evaluations or advantages of the ROI. It is widely accepted. It is in line with the ROCE. All right. As a common metric for measuring overall business performance. It is a comparative measure, okay, because it facilitates comparison between divisions. All right. So take note of that. That's detailed analysis. Look at how we analyze deeper into the profits, the timing of the asset and everything. All right. So that is that. The disadvantage here is that it it is asset bias because it uses net book value. Sometimes the assets are old, all right, but we are using it. We are talking about dysfunctional decisions because divisions may be rejected because divisions may reject profitable investment. Why? Because they think that it will give them a lower ROI. But you realize that it will help them to meet some targets, but because it is not meeting ROI, they may let it go. All right. And there is also manipulative risk because of profit, because profit is manipulative. Everybody knows that profit, people do earnings management in profit, all right, and all those things, sort of. Okay, so these are things you must, of course, and profit is also affected by accounting policies like depreciations. All right, so that is that. So basically, these are things you need to be careful about. Now, let's look at another question here. Okay, before we go to the second one, the residual. All right, so look at it. We have Gerard Limited has two divisions with the following information. Division A has profit and capital employed. So clearly, you see that the ROI has been calculated. All right, it has been calculated and you see it clearly. Now, what again? It says that Division A has been offered a project costing 100,000 and giving an annual returns of 20,000. Division B has also been offered a project costing 100,000 and the annual return is 12,000. The company's cost of capital is 15%. Okay. Then the divisional performance is judged on ROI, and the ROI related bonus is sufficiently high to influence management's behavior. What decision will be made by the management if they act in the best interest of their division? And what should the management or the managers do if they act in the best interest of the company as a whole? So we are looking at you acting in the best interest of your department because of the bonus thing. And we are also looking at the way what will happen if you act in the interest of the entire company, which is about the goal congruence. So this is it. Now look at this. What is going to happen? This is how you set it up. We have division A, right? And we have division B. Good. The old ROI that has been done is saying that this one is 30% and this one is what? 10%. Good. Now let's check how things are going to unfold. New ROI. The new ROI is going to tell us that we have already made some profits of 90, but another project has come, which is giving us a return of 20. That is the profit. Remember, I told you that it is not always the word profit that is being used. I showed you here that it is about gains from investment. All right. Also note that gains from investment. So here, what you are going to do is that you are going to add the profit you had before, which is 90,000, plus the project that is coming in that is generating you 20,000, so that you get a total profit. Okay, so then you divide this one over here, that you have a 300,000 capital employed plus another 100,000 project that is happening, all right, by your 100%. Good. You do the same for the other department. So that one too, you had a 10,000 profit before, plus another profit that you are going to get of 12,000, all over the 100,000 project that was there, plus this one that is going to cost you another 100,000, also by this. Okay, so you realize that this one gives 27.5%, and this one gives 11%. Now, you see, there is some form of saturation that is happening here. If the manager wants to act in their own interest, divisional interest only, divisional interest only, what do you think that they will do? Divisional interest only, this one, he will never accept it. No way. No. Because if he takes the project, it is going to reduce his ROI. Would this one do it? Of course, yes, he would definitely do it because it is going to increase his ROI. So the manager of Division A will not accept it because the dilution will cause it. But in the interest of the business, the entire business, so this one is divisional interest, group interest, the entire business, that is going to happen. Do you think they will go for it? It's a big question one needs to ask. Do you think the entire business is going to invest in this business? Because if this one does it, this is what will happen. Is this one that is does this is what will happen. Now, looking at it from the group point of view, you will see that you are in a very difficult position because both are costing 100,000. Look at it. Both new projects are costing 100,000, but one project is actually going to give a profit of 20,000, and another project is also going to give a project of 10,000. In the group, 12,000. This is 12,000. In the group perspective, what do you think will happen? So, are you saying that we are going to, come up with a situation whereby you end up accepting a project that is giving only 12,000 when you know that the project, this one, you are doing a project of 10,000, this one, you're also doing a project of 10,000, but one is going to give you a 20,000 return, the other one is going to give you a 12,000 return. Why? Look at the thing very well. This one is going to do it because it is saturating his ROI to increase. But the thing is giving you a 12,000 comparatively. So because the ROI, we call it, because the ROI is a defective decision-making method, that does not guarantee that the correct decision will be made, because you doing this for a project that is giving you a lesser return, all right, you are not doing it because it is giving you a lower return. But as a business, when I did the first project, it gave me a profit of 90,000 as a business. And I'm going to do another one that is giving me a profit of what? 20,000. But divisionally, this guy is not carrying it out. But if I look at the company as a company, remember, the ROI is just a measure for the department, not for the company. Remember, it is investment centers. But as far as the group is concerned, they would want to carry out a project because this project gave me 90,000. And this second project, if I invest in 100,000, it is going to give me 20,000. So as a business group, I am looking at something that is giving me 110,000. Not, think about it. A project, we are all spending 100,000. This one is giving me 12,000. This one is giving me 20,000. But because divisions are selfish, what they are doing is that they want to do it. But from a go congruential point of view, this thing will not work. All right. So that is the dynamics you have to consider in terms of your analysis when you are doing this thing in the examination. All right. So let's go to the next one, which is the how we measure residual income. All right. So that is that. I think your ROI is good. Let's go to residual income. Residual income. It is another measure we use to evaluate the investment center. Don't forget about that. Now, here, instead of using the ROI, like the percentages, like the ROI, here we are evaluating divisional performance using absolute profit. Absolute what? Profit. So take note of that. Absolute profit. So here we are using what? absolute profit. We are measuring divisional performance using absolute profit, not controllable profit. Okay, of course, we will use the word controllable profit, but the terminology here is absolute profit. We will go deeper into that. Okay, so I'm going to explain it to you. So how does this work? How does this work? Here we are using profit basis. RI start with the division's profit. The division's profit. Okay. So what is the division's profit? So we start with the division's profit. But remember, we said that when we are doing the controllable profit for the RI, we said that you cannot subtract, it is profit after depreciation, but you cannot subtract uncontrollable things like interest, right? You can also subtract things like predetermined rent, like those things that we mentioned. You cannot subtract all those things. All right. So here we are bringing in notional interest. All right. So here you will start with your profit, division's profit. All right. So the division's profit. Then you take care of notional interest. Notional interest. All right. So that is that. Now, when you say something is notional, it means it is imputed or we are pretending. We are looking at the interest charge, all right, from this profit on the capital. So here we are looking at some sort of cost of capital, all right. So there is notional interest, predetermined interest that will be charged on the investment. Because when you go and borrow money, you know there is interest, all right. Because you are using the capital employed, we are using interest, all right. So here you will charge a notional interest. Okay, so please take note of that. For the notional interest, we are going to subtract your interest from the profit because it is assumed that you went to borrow the capital and that you'll be charged some form of interest. And so we are going to consider, when we get your profit, we are going to consider some form of interest. Okay, so here do the interest. So it is the interest percentage that will be multiplied on your capital employed. All right, so your capital employed. So the interest percentage is like a cost of capital. All right, so that is that cost of getting that capital employed. So remember, you are going to take it out. So your normal divisional profit, which is called your controllable profit. Controllable profit. Okay, so basically that is that. So the money that you get after subtracting this is what we call the residual income. The residual income. All right, so that is that. The residual income, all right, is the balance that you get, which represent the divisional profit after accounting for what? Cost of capital. So this is it, after accounting for cost of capital. So that is what we are bringing in. All right. So that is that. But please note that the interest charge is notional. Okay. And it is solely used for performance evaluation purposes, not for actual financial reporting. Okay. So take note of that. So in a sense, your RI, your residual, in terms of your residual income, is the formula that you have over here. So in a sense, you can say RI is equal to, and don't forget, we still have your controllable profit. When you know how we come about with controllable profit, it is profit after depreciation, but before tax. So tax is still not something we are considering here. The only thing that is different from the ROI and the RI is that we are looking at residual, and so here the profit is a profit after interest, but still before tax. All right, so take note of that. So your RI formula is equal to controllable profit minus into brackets notional interest rates. multiply by what? Your capital employed. See, this one is closer to the EVA, but the EVA we will be looking at WACC. All right. So basically that is that. All right. So this is what you have. This is the profit. All right. You know, controllable profit. It is profit what? Profit after depreciation, but before tax. Not only before tax, but before all other things you cannot control. All right. So take note of that. That is something you must remember all the time. Okay. So basically that is that. And remember, you will still need your capital employed, and we have spoken about capital employed. You know what it goes in. The only thing is this one, the notional interest, which is also your cost of capital. Cost of capital. Okay. Take note of that. All right. So that is that. So you usually use the average cost of capital. All right. Which means that when you are getting the money, you will be actually like you are going to borrow it and you will incur some expenses in terms of borrowing it. Okay, so that is that. What are the advantages and the disadvantages of the RI? Now, of course, it encourages optimal investment. What do we mean by that? So, like I said, to each one of them, you have to get the advantages and the disadvantages. All right. So the good thing for you is that I think I have it in the over here. Okay, so the good thing is that it encourages optimal investment. Why? Because managers are motivated to pursue investment that increase their RI. Even though it may be lower ROI, if the RI is okay, like after deducting the interest, it is aligned with the overall business interest. You know, this one is more of goal congruence than individual divisional praises. And it also gives consideration to the fact that you are going to incur interest, the asset cost, the capital employed. There's a cost to that, and it incorporates risk because the capital cost of capital is issues of risk. All right. If the risk is high, it means the interest will be high. So that is that. But there is manipulation of risk because it's still based on profit, and it also limits comparability because RI is influenced by the size of the division because a small division cannot make a kind of source the fund in terms of going for the money than a bigger division. All right, so basically that is that. So let's take these quick examples. Later then we'll compare the RI versus the ROI. Let's take these examples. Okay, so here we have investment center has a net asset of, when we say net asset, it is also equal to the capital employed. So let me remind you so that you don't forget. Capital employed is also called net asset. All right, capital employed here. Where are you? Capital employed. Capital employed, because you see total asset minus your capital current life, it is also called net asset. All right, so please take note of that. Okay, so it says that your investment center has a net asset of 800,000 and makes profit before interest and tax of 160. Don't forget, it should be profit before interest and tax. That is fine, but you have to do the interest. You have to do the interest because it should be after the interest because it is residual. So to get your residual, you have your profit before interest and tax. What is the other name for profit before interest and tax? Profit before interest and tax is called operational profit. And you know, operational profit means that depreciation has already been deducted. Operational profit, what is left to be done is finance costs and investment gains. All right. Then you get profit after tax, then you tax. So you should know your IAS 1 in FR. All right. So here you have what? Profit before interest and tax is 160,000. So we will do our notional interest to get our residual income. And the notional interest, the cost of capital is 12%, multiplied by the net asset, capital employed, which is 800,000. All right. And if you do that, you are going to get 96,000. You subtract it and you get your residual income of 64. So that is how we do the residual. All right. So this is your RI. Okay. Take note of that. Now, be mindful that in some question, the cost of capital may not be available. This 12% may not be available. Now, so if the capital employed, may not be available, like the 800. So if the capital employed is not available in the question, you'll be giving some net assets. So you also will substitute them. So because I've told you that it's the same thing, all right? It's the same thing. Okay, so quick note of that. Now, investment centers management, what you realize is that they make decisions on the basis of short-term performance, not long-term performance. So here, we will rely on the RIs that are positive to accept whatever project that they are undertaking. All right. So basically, that is that. All right. So now, quickly, the next thing for us to do is actually discuss the between the RI and the ROI. Look at this. Both ROI and RI tends to favor the divisions with older assets. That is true. Historical cost advantage. Older assets are likely to actually contribute to the profit than the newer assets. You saw the question that we did that some of the asset was too easy, we had to subtract. All right. And depreciation is also an impact because depreciation reduces the capital employed. Depreciation affects the assets. Okay. And these things causes distortion. All right. But the truth is that the ROI has gained popularity. It is popular, it is most widely used, but the RI has technical superiority. Okay, so RI is better at encouraging managers than, because it involves what? The risk, the cost of capital. All right, so that is that. Let's see, we have an illustration here. Let's see how we can carry out this illustration. So we have investment center that has net asset of 800,000 and made a profit before interest of 160. The notional is 12%. So the question we just did. And it says that an opportunity has arisen to invest in a new project costing 100,000. The project would have 4 years useful life and will make a profit of 15,000. When we give you useful life, what should come to your mind? Depreciation, is that not it? All right, so that is that. When you have a question like this, it says that what would be the ROI without the investment? All right, so based on the calculation on the book values. All right, would the investment center wish to undertake the investment if performance is judged on ROI? Then what would be the average annual RI with and without the new investment? So the same thing we are going to do. So when you get a question like this, you set up A, we are doing ROI. So we say with, or let's say without the investment, because the investment, that is the first thing you had. Then with the investment, all right, what will happen? So that is how you set it up. Okay, so without the investment, your controllable profit was how much? 160,000. Okay, and then your capital employed was how much? 800,000. So based on ROI, what do you think would have been? You just do your division. And by that division, you are getting 20% as your ROI. Good. But with a new investment, what is going to happen? What is going to happen is that your profit is going to increase. We have 15 and you have 60 here. All right. Your profit is going to increase. And that profit is going to be 175,000. Is going to increase. All right. You were not told that that profit has depreciation has already been deducted or not. You were not told, so you take it like that. If depreciation has not been deducted, you know the asset value. You also know useful life. You divide it, you get the depreciation for 1 year, and you subtract it from your profit. Okay, so that is what you would have done. Okay. Now, because the project was undertaken, how much is your capital employed now? It is 100,000 plus this one. So now your capital employed is now what? 900,000. So by this, if you are going to do the project, you have 19.4. Clearly, the guy will not do the project based on the RI. Why? Because based on the ROI, because the project will saturate the thing to reduce. So he will not want to make the new investment since it will deteriorate his performance. Have you seen what will happen? So that is the thing that is going to happen based on the ROI. But let's look at the RI. All right. So yeah, your comment is that about taking the project, no, because it will make his performance go down. But let's look at RI. Now, RI without the project, don't forget there is a cost of capital involved now. Without it, the profit is how much? Still 160,000. That's the controllable profit. Good. The notional interest will be how much? It will be 12% multiplying the cost of capital of 800. We have done this one already. If you remember, it was 96. And so therefore we had 64 for the RI. Now, when they do the new project, here is 175,000. All right, together. The notional interest will be calculated on 12% multiplied by 900,000 because that is the total there. And that one will give me 108,000. So if I now subtract, I'm getting 67,000. Do you think this guy will do the project? Of course, he will do because there is a change of 3,000 improvement in it. So of course, he will definitely do it. So these are the things you compare in terms of the decisions that will be made. All right. So that is it. Okay. So basically that is that. Let's take another illustration. We have illustration 6. Illustration 6. In illustration 6, we have division X. The net assets are given. Current divisional profits are also given. Investment has appeared, and that investment will cost 100,000. Projected profit is 20. The required ROI is 18%. Now you are required to do both ROI and RI. This is easy, right? You've been doing this thing already. So all you need to do is to set up your division. So we have division X and we have division Y. All right. You have been asked to do the ROI. So please do your ROI first. Okay. So with this one, what is your profit? You know your profit is here, and you know this. So if you calculate without the project, so here let's say ROI, let's say without the project. So you do for both ROI and RI for both businesses. Okay. So clearly you can use your calculator to know that the ROI is 250 divided by this. All right, you have 25%. And this one to what do you have? That is 12%. So basically that is that. So let's do 250 over 1 million. To 120 over that, you have it. Basically that is that. Now, what about your RI without any projects? The cost is 18. So you know how to do that. If you do a working somewhere, you realize that all you are doing is that you have a 250 already. Okay, that is your profit. And what you are doing is that you are doing 0.18 multiply by, that is the 18%, 0.18, multiply by the 1 million. and that gives 180,000. So if you take your 250 and you take away your 120, I think that is giving you a plus of 70, uh, 70,000 cedis. Do the same thing for this one. You realize that that one will be giving you a negative of 60,000. All right. If you want to, if you want to show the workings, all that you are doing is that, for example, you pick your 120,000, you are doing 18% on the 1 million, and that was 180,000. And so when you subtract, you get a negative of 60. All right. So that is all that you are doing. So you have that. But I'm interested in bringing in the new project. Okay. This RI is negative, and so you wouldn't have even ventured. All right. So with the project, that is where I'm interested in. With the project. With the project, how is it going to be? So you now realize that there is a project. So my capital employed now happens to be 1.1. You see that clearly, is that not it? 1.1. And this one too, same, 1.1, because you add them. Good. Then if I'm doing, again, what I have is my profit being what? The profit is what? 270, right? You add it, this plus this, 270. And the profit here is what? 135, right? 135,000. Now, if I'm doing RI or ROI first for this, all that I need to do is to take 270 divided by 1.1. And that is giving me 24.5%. And this one is 135 divided by 1100. That is giving me 12.27%, or let's say 12.3%. Okay. Clearly, you see that, hey, this guy per percentages, this one is increasing and this one is coming down. So you will know the decision he would want to make. He wouldn't do the project. Let's do the RI. The RI to, what will happen? Of course, you are picking your 270. Now it is 18%, 0.18 multiplied by 1100. That is 198. If I now do that against my 270 minus 270 minus that is giving me 72,000. The same thing, we know that the interest is 180. Now 180 minus 135, that is negative 63,000. So this guy, based on the RI, will definitely go for the project. So that is the analysis that you have to make. All right. So basically, that is that. All right. So basically, that is it. Now let's go to the EVA. Right before the EVA, there is something called EBITDA. EBITDA. What is the full meaning of that? We are looking at your profit. So your controllable profit. You know what controllable profit is about by this time. All right. But here you are going to add depreciation. Okay. And you are going to also add amortization. Amortization is the depreciation for intangible assets. So it's called earnings before interest and tax. Earnings before interest and taxes, depreciations and amortization. All right. Depreciations and amortization. All right. So basically, that is that. So it is before, sorry. Here, it is before them. It is before these things. So that is it. It is actually before them. So if you look at it very carefully, it simply means that you are looking at it's a financial measure, but here we are looking at profits, accounting profits, all right? but which is before non-cash flows, all right, non-operating expenses such as your interest. These are not operating things. So if you are looking at the EBITDA, you are looking at your profit before interest and tax, which is also called your operating profit, all right? Profit before interest and tax, and also before your depreciation and things, because depreciation and amortization are not operating expenses. So here, basically, we are saying your revenue, all right, and you are taking away your operating expenses. If you know your IAS 1 very well, you will know that operating expenses are selling and distribution, administrative expenses, and research expenses. These are your operating expenses. So it does not include depreciation. It does not include amortization. It does not include finance costs, interests. All right. So that is that. Okay. So basically, that is that one. So whenever you get a question, you can apply that. But most importantly, let's come to the last one for the divisional performance management. We are going to look at EVA. EVA. Economic value added, also called EVA. Okay, so basically that is that. Now, EVA is also a financial measurement. All right. Here we are looking at the value the whole company generates or the division is trying to generate. All right. Okay, so from its operations after accounting for cost of capital. So it's just like the RI, all right? So how much are you going to get after accounting for your cost of capital? So just that here, we are looking at, this is your formula. We are looking at value added. So here it is giving us the net operating profit, okay, after taxes. I think by now you have understood it. The other ones we are doing, it was not after the taxes, but here this one is what? After taxes. So we call this one no part. Okay, no part. Then we are going to subtract like the way we did it for the residual. We are going to get into bracket our cost of capital, which usually is your WACC. You remember WACC in finance management? So here we are again. Your WACC, so cost of capital multiplied by the capital employed, the cost of the investment or net assets. So this is how we deal with EVA. So profit after tax, you know what your profit after tax is. So it represents your operating profit after tax, but it is before finance cost. So it is tax, profit after tax, excluding finance cost. You know what finance cost is? That is the one we call interest. So if the interest has already been deducted, come and what? Add it back. Come and add it back. Remember, cost of capital is your WACC. So remember the average cost of capital from debt, from equity, WACC. All right. We said that this one is also called cost of investment. And timing of the asset is considered. Don't forget that. And also called net asset. All right. So take note of that. So that is that. So the thing is that inside your profit, you need to make some adjustments. So be careful. There are some adjustments that you will be required to make. All right. This is profit after tax. All right. So what you have to understand is that the major adjustments are that we need to take care of expenditures, future expenditures. Okay. We need to take care of non-cash expenditures. Okay. So we need to take care of what do we call it? Provisions. We need to take care of goodwill written off. We need to take care of depreciations. All right. So please take care of those things before you come and calculate, because it is net operating profit. Look at this. Operating profit. Take note of that. So the things that are not operating, things like provisions, they are not operating. If those things were deducted, add them back. Provisions are not operating. Okay? Non-cash items like depreciations and amortizations, they are not operating. When we say operating, we are talking about what you do regularly, the expenses that you generate because of your daily activities. And those things are only three things. I've already shown you that. Those expenses are selling and distribution, administrative expense, and what? Sometimes you can consider research, because research are kind of regular things probably you are doing. In terms of IAS 38, we consider research as part of but here we don't, because it is not part of what you are doing on daily basis. You don't come to do the research, you have to exclude it. All right, so you may have to add back the research. All right, so take note of that. And some things of things like staff trainings and all those things, they are not something that you are doing on regular basis. Okay, you are not set up to do that. Okay, so it's basically selling and distribution. Okay, so basically those things. So goodwill written off, added back. Okay, depreciations, I've already told you to add it back. Interest, finance cost, add it back, because we will cater for that one here. So please make sure you add these things back. All right, so that is that. So the things that you are going to do here will be the cost of, this is cost of debt capital and cost of what? Equity capital. So the weighted average of them. All right, equity capital, the weighted average of them. All right, so now you have to understand that. So please understand that if this one is capitalized, that is why you have to remove it. But a research expense, normal research expense, like maybe you were developing a project, and it depends on the way the question will say it. All right, so that is that. Look at the way the question phrases it, because if the we call it research and development. In accounting, the research is part of your operating expenses. So look at it. But if the question mention it like development, I think that is the key thing. Okay. If the question mentions it like development, which means it has been capitalized or not, because it's man accounting, they will tell you that the research is capitalized. So that is why you need to. So depending on how the question say it, be very, very careful. All right. Because if those things are meant to be capitalized, then that one should be part of your asset. All right. So that is that. Okay, so you have to also make some adjustment to your debt. Okay, your debt. So again, non-capitalized leases. All right, research that is now capitalized, goodwill that is written off, provisions. I mean, all those things are part of your debt. So here, the research will be part of your asset, which, I mean, if it is capitalized. All right, take note of that. Goodwill is part of your asset. Provisions are part of your liabilities. Take note of that. All right. Take note of that. And leases, they are all part of your liabilities. All right. So take note of that. All right. So basically, that is that. That is that. Now, remember, this EVA is looking at value creation. What value have you given? All right. From the money that you borrowed. So it is also a performance indicator, but this one focuses on shareholders' wealth. It is good for financial management. All right. So because the advantages of this one is that, let's see if you have some theories to talk about. The advantages is that this one is focusing on shareholder wealth maximization and capital efficiency. Okay, good. This is that. Shareholders wealth, capital efficiency. All right, investment decision. This is it. All right. So that is that. The disadvantage is that it is a very little complex thing for a non-accounting student. You can see that. All right. There are so many accounting adjustments you can see as we are doing add back depreciation and all those things. It is also short-term focus, which is not good. All right. Even though it is looking at shareholder wealth maximization at short point in time. All right. We use it for these things. And so the best thing to do now is to look at our illustrations. Let's look at our illustration. Remember, after the EVA, we will do a third video separately on transfer pricing. All right. So that is that. We will look at transfer pricing. So that will be part 3. We'll be looking at transfer pricing in the part 3 of this course. So let's look at some illustration. We have this year extracts of account of value company limited 2013. Look at the figures very well. Very well. Look at it very well. I hope you've captured it because there are profit, pre-tax accounting profits, and there is a note they've given us. You will check that. Taxation, profit after tax, dividend, retained earnings, balance sheet is also given. We have the balance sheet items. So this one is your income statement. This is your balance sheet. All right. So basically that is that. Let me see if I can take this one off and place it here. So you can look at them like this. Good. All right. So you can see the thing clearly. The balance sheet has balance. Look at this. Non-current asset, net current asset. All right. I hope you know net current asset, meaning that current asset minus current liability. Financed by is here, and you have your medium and your long-term debts. It says that additional information says that note after deduction of the economic depreciation of the company. So it means that profit that you have there is after deduction. And this is also the depreciation used for tax purposes. That means the depreciation is equal to capital allowance. Other information is as follows. You have this capital employed at the end of 2012 is 350. Value company has a non-capitalized leases at 60 million at each year's 2012 to 2014. The leases are not subjected to amortization. You have additional information here. Value code pre-tax cost of debt is this, and it was 10% in this year. Then the cost of equity too is also given. This is good for your WACC calculation, these two information. All right. The target capital structure is this, so good. That is also good for your WACC calculation. Your tax is 30% in both years. Economic depreciation amounted to 64 million in this, and also here. These were equal to the depreciation for tax purposes. That means it's equal to your capital allowance, and depreciation is charged in the income statement already. All right. So that is that. Then we have interest payable amount to, this is finance costs. Understand it. Non-cash expenses amount to this. You know why we are giving. Research and development expenditure. Have you seen the way it is quoted here? All right, like I was telling you, on a new project. So when it is research standing on its own, I mean, you can look at it as part of your operating because that is IAS 1. And you must say it to the examiner that according to IAS 1, research is part of operating expenses. You must say it to the examiner. Don't just leave it like that. Okay, so here you have been asked to calculate the EVA for the 2 years. So what you need to do is to do the adjustment on your capital employed and also the adjustment on your profit. That's the first thing you need to do before you can pick up the formulas, because you must start a question like this by saying EVA is equal to NOPAT minus into bracket cost WACC, in this case cost of capital WACC multiplied by capital employed. So you are going to work each one of them. So now you say your NOPAT, you do adjustment on your NOPAT. The question gave you the profit after tax, right? But it should be net operating profit after tax. He gave you the profit after tax. And if you look at your listing, well, your profit after tax is here. So you are looking at 2014 and 2013. The profit after tax here, so please, you can put your currency there. Profit after tax in this year is 88, and this one is what? 71. And you are coming to adjust them. Do you remember what we said? Number one, non-cash items. So you do the adjustment, non-cash items, because you were told that these notes from here includes the things that are in there. So non-cash items, what is the non-cash items that are inside the thing? Non-cash items, I think you saw it. Where are you? Good. Non-cash items, you have to add them back. So this is 20 in 20 here, 2013, and 15 in 2014. Add them back. Good. What else? You saw research and development, R&D. And R&D here in 2013 is 10. Okay. And the R&D, so this is it. Research and development here was 10 in 2013 and 11 in 2014. So you have to deal with that one too. So 11 and 10. All right. So take note of that. What else do we need to do? I think you saw issues of depreciations over there and finance costs also, because this is the interest. Interest, they are telling you that that thing was also deducted already. You have to add them back. Add back interest, because interest is not an operating thing. Finance cost, it is not part of operating activities. The operating activities is solely your selling, all right, because that is what you are in there for, and the things people are doing in the accounting department and all those things. All right. So here is how much you have over here. The interest, where is it? He said that interest payable amounted to 6 million, all right, and also 8 million. But you have to be careful in this one, because it is an after-tax interest. You have to be very, very careful. You know, the interest that is included here, we are going to adjust it after-tax interest. Do you know why? Let me show you something. What you need to understand is that, let me show you IAS 1, so that probably you will get to know all these things. We have revenue. I think I showed you in the part 1 video. We have cost of sales. And so you get what? Gross profit. Then operating expenses. Operating expenses, according to IAS 1, includes selling and distribution, administrative expense, and research, when research is standing on its own. Okay? There's nothing like development there. Development purely is an asset, all right? So that is that. You combine all these things, all right, as your expenses. So combine them. Then you get what we call operating profit. All right, operating profit. That is that. Let's continue. So this is what we call operating profit. All right. So when the question says net operating profit, all right, this is what we are talking about. Net operating profit. But after this comes finance costs. Finance costs. Then any investment income. So you see, depreciation can find itself here, and or it can find itself as part of this one. So depreciation is inside somewhere there. Or if you have any other investment income, you also add. So when you when you add this one and subtract the finance cost, you are now getting what we call profit before tax. Profit before tax. Okay, profit before tax. Now watch this. Profit before tax. Then tax comes. Good. Tax comes and we now have profit after tax. Profit after tax. This is what IAS 1 says. So be bold about the research thing and tell the examiner that, okay? But when the research is with development, bear in mind that one is purely an asset, okay? So that is that. So that thing must rather be added to an asset other than, so that thing must be added to your capital employed rather than treating it as part of your what do we call it, your expenses. So but when research is standing on its own, make the argument that according to IS1 it is part of it. All right, so be careful about that. Now watch this. This is net profit. It is not net operating, okay, because operating things ends here. Good. And so that is why you need to come back and add, if the finance cost was subtracted, you need to go back and add it. All right. If the investment income was also part, you need to come back and subtract it. Take note of that. This is what we do in cash flow. All right. But tax, we said no part after tax. So you have to tax. Now watch this. If there were interest here, okay, the interest was already deducted before we came to get our profit after tax, which means we've already taxed the interest as well. We have taxed the interest as well. So if you pick this figure, okay, and you are coming to add back the interest, it has already been taxed. So if you just come back and add the 6 million, you are making a mistake. You are making a mistake. So you need to do the post-tax of the interest before you can subtract. Be careful about that. The post-tax. You see, everything that is here, all right, we have taxed it. Take note of that. It's different from those ones that are at the top here. Okay, be careful. I mean, it's tricky. Now, what you need to understand is that for every interest that you pay, you get tax savings. Modigliani, that is coming from FM. You get tax deductibility on interest. Okay, so that is why when you are coming to add back, you need to add back interest 1 minus T. Be careful about that. Okay, that is coming from Modigliani because it says that interest, you know, the interest is allowed for tax purposes, but depreciation is disallowed for tax purposes unless that depreciation is equal to your capital allowance. This thing is tricky. Okay, so be careful. Let me take time and let you understand. So remember that for interest, it is allowed for tax deductibility. All right, that is coming from Modigliani, which means that you get a tax savings on the interest. We do this thing in even in FM when you are doing what we call it lease or buy, that thing in FM, tax relief on the lease amount, the lease renter. So that is what we are talking about. So understand that when you are adding back the interest, it has to be interest 1 minus T. So when you come here, what we are doing in the adjustment, for example, this one, the interest for that year is 6. So it is interest 6 for 2013 So let me do it here. Interest 6, 2013, 1 minus T. The tax rate is 30%. So 1 minus 0.3. All right. So that is what you do. And what about this year? 14, it is 8 into bracket 1 minus T, 0.3. That is what you would do. And so that is how you would do that because of the tax deductibility of interest. Take note of that. And so here you are going to get something around 5.6. Change the ink. 5.6. All right. That's what you are adding back because you are adding it back to profit after tax. That is the reason. That is the reason. You are adding it back to profit after tax. All right. So that is the meaning. You have already considered tax. If it were this profit there, you wouldn't have a problem. You would have gone straight. So you can decide to pick this one and add all this 8 and the 6 million. But the moment you pick this one, tax has already happened. So it must be 1 minus 1. All right. T. All right. So take note of that. So please, that is something you need to be very, very careful about. All right. Okay. So that is that. The rest were non-cash, and misplacement of things. So that is fine. Okay. So be careful about that. And this one will be what? 6 and multiplied by 0.7, you have 4.2. All right. You add back depreciation, which is also non-cash. But remember, the depreciation is equal to your capital allowance, so you leave it like that. If the depreciation was different from the capital allowance, you add back. All right. But this one, they said that the amount was equal to the one for tax purposes. All right. So basically, that is that. So it tells you that what is actually there is capital allowance, not your depreciation. Because for every asset, you are looking at the capital allowance. You take away the account non-cash, which is your depreciation, but the one that you actually deduct will be your capital allowance. So when you disregard your depreciation, you'll be deducting capital allowance. And so if your depreciation is equal to your capital allowance, then you just leave it like that. All right. So basically that is that. So after this adjustment, what do we have? After we have adjusted our figure here, what do we have? What we have is that this one is 119.6 and this one too is 105.2. So you have adjusted it. All you have done is this one only, no back. Okay, so that is that. Then what is our capital? The WACC. We can also do the WACC. How do we find our WACC? You remember how you used to do work in what do we call it? Finance management. So here, the cost of capitals, where are they? Okay, so this is it. The cost of capitals. Do you remember the cost of capitals in work is supposed to be post-tax, not pre-tax? Do you remember? Yeah, so the cost of capital for work is supposed to be post-tax, not pre-tax. All right, so what do we do? Sorry, what do we do for 2014 and 2015? So let's do work for 2014 and we will later look at the work for 2013, or because we can also start with 2013 first. Okay, so how do we go about it? You are told that this is cost of capital is 15%. Now the 15% should be 1 minus T first in the first place. So 15%, 1 minus T. So you can, the T is 0.3. So you can as well say 15% 0.15 multiplying 0.7. All right. So basically that is, it must first be post-tax. Then as it is post-tax, you are going to check it against, the other ones. Okay, so here, this one is 2013. That is the equity. All right, the equity. But the capital structure is 70% equity, 30%, 70% equity, 70%, 30% debt. Okay, so remember this. Let me remind you of, I'm sure some of you have watched my FM videos, so let me show you this. This is how we do it. It is KE multiply by VE over VE plus VD plus KD. Okay, the KD should be 1 minus T. All right, multiply by VE, VD all over VE plus VD. Okay, so this is what I'm talking about. Basically, that is it. So this is the WACC calculation. So if you check cost of capital for the equity, you are told that cost of equity capital is 15%. So this is 15%. Multiply by what is the value of the debt? The debt is 30%. Sorry, the equity is 70%. So that is 0.7 all over 0.7 plus 0.3. Have you seen how it works? Then you come here, KD. KD is given by what is the cost of debt? And it is pre-tax cost of debt. Okay, so this one is 9%. So it's 0.09. This one too, you can write it as 0.15. Okay, so let's just ensure uniformity. 0.15. All right, so this one will be 0.09, that is 9%, into bracket 1 minus T, tax rate is 7, here will be 0.7, multiply by, we are looking at our debt. The debt is 30%, which is 0.3, all over 0.7 plus 0.3. That is 1. Have you seen that? So when you do this, what are you getting? And this is only for which year? 2013, all right? So you will do same for 2014. Okay, so when you do this, we have 0.7, okay, divided by 1, okay, multiplying 0.15. That is 0.105. So plus 0.09 multiplying 0.7. Okay, that in itself is 0.03. And that one is going to be divided by, multiplied by 0.03, 0.3, sorry, over 1, which is the number itself. That is giving me 0.0189. So this plus 0.105. And that one is giving me 0.1239. If I want to round it, it is giving me 12.39%. Can you do the same thing for 2014? Sorry. Can you do the same thing for 2014? 2014. So the same formula, KE. So what is your KE for 2014? That is 17%, 0.17. Multiply by the same thing that you did here, 0.7 over 1, because this plus this is 1. Plus, what is the KD? It's 0.1 into bracket 0.7. 1 minus T is 0.7, don't forget. All over 0.3 over 1. Easier, right? So 0.17 now, multiply by 0.7. That is 0.119 plus 0.1 multiplying 0.7. That is 0.07 multiplied by 0.3. That gives you 0.021. All right, so that is that. If I combine this plus 0.119, that gives me 14. So that is 0.014 or 14%. So I've gotten my WACC. The last thing that I need to look out for is the capital employed. So the capital employed too, you need to do your adjustment. You see, it's a lot there. And so no, when it comes to EVA, be careful, capital employed. And that is what your examiner has been doing these days. All right. So the capital employed, you need to also do the adjustment. So in 2014 and 2013, is that how we arranged the first one? Yeah, that is what we did. So at the start of our year, what was our capital employed? The balance sheet. All right. So what we see in here is that if you look at your 2014, what will you say is your capital employed? Because we say capital employed is what? You can look at um, total asset minus current liability. You can know that, all right? You can do that. And you can also be looking at some things like um, issues like shareholders fund plus. But you see, you were giving a capital employed at the start of 2012. So that tells you that this 350 is the opening. So you start with your opening capital employed. Okay. For 2013, it is 350. Okay. And you add certain things that were not added. Okay. So you have to add all those things that were not added in there. All right. So that is that. Now, you need to understand that the capital employed, basically, this is what it is. Have you seen that? This is what it is for the end of 2013. That is what you have here. But you have to make some adjustment. So the capital employed, you can pick the opening capital employed for 2014 from 2013. So these ones. Be careful not to just pick these figures and do, because it requires some adjustment. It requires some adjustment. So wisely, if there is no adjustment, you can pick them. But because there are some adjustments, you are giving the opening capital employed for 2012. All right. Sorry, at the end of 2012, which will be the opening for your 2013. And this one too, this one will be the opening for your 2014. That is how you look at it. All right. That is how you look at it. And you were told that there are some non-capitalized leases, right of use assets. So if you are an accountant by now, you know that the right of use asset should be part of your capital, which they didn't do it. All right. And it is not subjected to amortization. Very, very important. Very, very important. And so that you, if it is subjected to amortization, it means you need to be adding the net book value of it. So it means in 2014 to this, you need to add the net book value. Because if there was amortization or depreciation, uh, we don't consider those non-cash, but because you are picking all these things are carrying amounts, you have to consider those things. So here you have to add 16 to it. All right, you have to add the 16 to it. Very, very important. Right of use 16. It was the same throughout the year up to 2014. So you have to add that. Okay. But one thing you should also understand is that that thing of the research and development is an asset. When did that one happen? The research and development, when did that one happen? Where are you? Where are you? Where are you? So the research and development started in 2013 on a new asset that started in 2013. So if it was research alone, you should understand that it is research, but it will be developed. So, and he said, and it was written off was 10 here and 11 also here. Now, you need to understand that in 2014, you are adding it back. You are adding it back. So you need to understand these are figures that are given to you that must be added back. Very, very important. Now, what are you going to do in terms of you adding this one back? Now, this is what you do. 10. Now, I'm going to explain to you why I wrote the 10 here. Because you see clearly that when it comes to the figure that you have, it is 10 for 2013, but I've written the 10 for 2014. All right. And I'm going to explain to you why. It's a simple understanding that you need to get. Don't forget, for example, you see, we started with the opening balance of 350 for 2012. Okay. Started with that for 2012. Now, that 2012 figure, what it really tells you is that if I pick the 2012 figure for 20, so let's say if I pick the figure for 350, it is a figure that is at the end of 2012 closing balance. All right. Meaning that if there was any adjustment that were to be done, those adjustments would have taken place in the 2012. All right. So if I bring this figure to 2013 as 350, what you see is that this 350 has only have all the adjustments of 2012 happening. Basically, that is the meaning. All right. So if I bring it here, it means that I've also come here with the adjustment of 2012. Basically, that is the meaning. All right. So what you should understand here, for example, is that, all right, guys, sorry, I had a call I had to attend to. All right, so now I'm back up. So what was I? So I was saying that this 350 figure is all the adjustment of 2012 have been done, and so we brought it here. So if you pick your 2014, oh, where are you? Where are you? If you check your 2014, that figure two that we brought there was 400, meaning that all the adjustments of 2013 are also included in already in the 2014 figure, because the figure that is here already includes all the adjustments that were done in 2013. All right, so this one is also a brought forward, meaning that all the adjustment in 2013 has already been done before we had this thing. So the adjustment of 2013 are inside the 2014 balance brought forward. And so that is why when I'm doing this one, I adjusted, where is it? The R&D of 2013 is what I have added back. Have you seen that? Because that 400 here brought down is having all the adjustment of 2013. What were the adjustments of 2013? The adjustment on 2013 on this capital allowance is the fact that they have written off, what is the figure here, of 10. So it is done in my 2013 figure of 400. It has been written off. And therefore, what did I do? I am adding it back. So have you seen that? Basically, that is that. Because I picked an opening balance. All right. The opening balance of 2014 is coming from every adjustment that have been done in the 2013 figure, which included this one that was written off in 2013. So I need, because I picked the balance brought forward, I need to what? Come and add that adjustment back. The same thing for the right of use. Now, what was the right of use? Right of use, right of use, right of use. Where are you? Right of use. Where are you? Right of use, right of use. This is it. Now look at this. It said that the non-cash lease of 16, all right, for 2012. You see, that is why it affected the 2013, because that one was not done. It came from 2012. So this figure that has been picked, the adjustment of the lease of 2012 has not been done. That is that. But apart from here, nothing will be done, because there is no, all the adjustments has already been catered for and have been included in the balance brought down here. So basically, that is that. Do I have any research and development for 2012 to adjust the opening balance? No. Now, someone will say, oh, say, then why shouldn't you, in 2013, why shouldn't you pick this figure, 2013 of 10, and adjust it in 2013? Meanwhile, this new project started in 2013. So the figure that I've picked here, all right, this is a figure of 2014 figure, 2012 carried down that has become the brought down. So is there anything in 2012 I should have considered it? No, I don't have such. All right. So basically, that is that. All right. So that is why. And so, where is the non-cash item? The non-cash item to what do you think I will be doing? So the non-cash item that you see here is 20 in 2013 and 15 in 2014. Now look at this. The one in 2013 has been dealt with inside this figure, and so therefore it's inside the balance brought down, and therefore when I come, the non-cash item too that I'm dealing with it here is the one that was done in the 2013. Basically, that is that. All right. So that is the understanding that you need to, right, come to conclusion with, that understanding you need to get. Okay. All right. Quite confusing, right? Yeah, yes, I get it. But what you need to understand is that because you pick the opening balance here, only the adjustment on the 2013s can be done on the 2014 opening balance. That is the idea you need to get. Only the adjustment on 2013 can be done on, because this is so it means that adjustment should have been done in 2013, and those things are done in there, and so we can only adjust them on the opening balance. Now, do we have, this figure is coming from 2012, do we have any issues of 2012 for the adjustment? The only one we had was the one that came from the lease, which is from 2012, so we had to adjust it. All right. So we will adjust 2012-16 on the 2012 balance, okay, which is the balance brought down in 2013. And we will adjust 2013 in the 2014 balance. What about the 2014 figures? We will use it to adjust 2015, but our question is not about 2015. So that is the thing you need to be really careful about. That is what you need to be careful about. So when you are adjusting your opening capital employed, you must adjust it with things that came from the closing of the last year into it. All right. So, ladies and gentlemen, that ends it for here. So, when you total this one, you are getting around, that is, this one is 4,366, right? That is that. And when you look at this one will give you 446. All right. So just be careful. After this question, I'll give you a template that you should be following. All right. So take note of that. This is very, very important. Now, once you have had this, your computation is no more difficult, right? Because if I now have to calculate the EVA for 2013, my EVA is going to be my profit after tax. How much is the profit after tax? Net operating profit after tax, that is for 2013 is 502 105.2 105.2 minus into brackets the cost of capital, which is the WACC for 2013 is 12.39%. 12.39% multiplying 366. All right. So that is that. And that will give me an answer of 59. This is in millions. So let's say 59.85 million. All right. So that is that. For 2014, we have the figure that we had there was 119, right? So 119.6 minus into bracket. The cost of capital was 14%, multiplied by the figure that we have here, 446. All right, then when you punch that, proxy, you have 57.16 million. So that is how you go about it. All right. So I need to give you a universal template that you need to use, but because you need to be careful around this one. So I'm going to give you a universal template, all right, that you need to, kind of run over in terms of dealing with these things, okay? So be careful. As for the capital employed, when you pick the opening balance, adjust it with things that were, that that came with the opening balance, like coming from the previous year. It's very, very important. Okay, that came from the previous year, the previous year, the previous year. All right, because you pick the opening balance from there. Okay, so let's give you a universal template for the adjusting of the profit. I think I gave you some here, but let me unify it. All right, in terms of explaining these things. Yeah, I said you adjust for all of these things. Let me make it a universal format for you, because in the part 3 of the videos that I'm going to do, when we consider the transfer pricing, I'm going to solve a past question on the EVA with you, then we do the transfer pricing. All right, so take note of that. So here we know that the EVA, we will need no parts. Okay, no part minus into brackets WACC multiplied by capital employed. All right, and so we are saying that we need to learn some adjustment on the WACC, the capital employed. As for the WACC, you've seen how you are going to be dealing with the WACC. Okay, and so that one shouldn't be a problem. But let's look at the adjustment that you need to make on your these things. Okay, so for example, when you pick the capital employed, you will start with the opening balance. So opening balance of what? Of your equity, right? So just as you saw, pick the opening balance of your equity. So the balance brought down of the equity, meaning that is the balance carried down from previous year. That is what you pick. All right, that is that. And so it is capital employed. And I said that when you pick that, the next thing you are going to do is that you are going to adjust all these things. All right, so you have to adjust it. Now, remember, there are issues of research and development. So you saw in the question that we just did. All right, so the research and development, because this is an opening balance, so let me write something like a brought down. So you have issues like research and development. I have explained to you the concept of research and development. This is a combined one, okay? So that research and development written off, you are adding. And this is coming from the last year, all right? So it is also coming from the last year, all right? This is the expense that you write off in the no part, all right? So take note of that. Take note of that. Other things is that you also have to account for depreciation. So please remember to take away less the depreciation. Let me do it like this. I say add back the depreciation. So add back accounting depreciation. Okay, so let me write it like that. Add back accounting depreciation. So the accounting depreciation. Then less the tax depreciation, the tax month depreciation, or we also call it the economic depreciation. In the question that we just solved, it was equal, so it's knocked off itself. All right, so remember to do that. Remember to do that. Then you see this one is the opening balance, okay, the one that is coming from last year. So let me hint it for you, because this thing is from last year. So carry down from last year. This one too is what? From last year. Not this year, it's from last year. Take note of that. Then also you are going to add back provision for doubtful debt. Doubtful debt. That one too is the from last year, the carry down from last year. From last year. Not the brought down, the carry down, the ending of the last year. All right, so please remember the opening balance of that one too. Remember to add that one too. All right. So please be careful. All right. Then, of course, this is equity. And so interest-bearing debt. Remember, I said capital employed is what? The shareholders fund plus what? Interest-bearing debt. Interest-bearing debt. All right. Don't forget to add the interest-bearing debt. Okay. So please, this is what you need to remember, especially when it comes to economic depreciation and what this the accountant depreciation. The one we do is manipulative, all right? And also remember to bring these things that are coming from last year, all right? So take note of that. And what did we also add? If you remember, the lease, okay? Please, the lease is now called right of use. This is not operating lease. This is finance lease. It's now also right of use, all right? Don't forget that one too was coming from what? Last year. All right, that one too was coming from last year because the figure that you have picked to adjust here is always from last year. So the question that we just did should open your eyes more to it. All right, so take note of that. So similarly, the non-cash from last year, lease right of use from last year, the non-cash that I'm talking about here may include the depreciation or amortization. But if the question also give you some non-cash from where? So non-cash items, okay? Non-cash items that are included, all right? Also from what? Last year. So you saw in this question, we had some non-cash items. Where were they? Other non-cash items, all right? Okay, so you dealt with it inside it, all right? So per what we just saw, we dealt with the non-cash items also in there. All right, so I think that should be enough for you. Okay, we did the lease, we did the non-cash expenses. All right, so that should be enough for you for any exams. All right, from last year. So that is how you adjust it. Of course, as for the work, you know how to do the work. And the no part too. All right, you need to learn how to adjust the no part. You have a choice, all right, to go about how you are going to deal with your no part. Okay, because one can decide to pick the what do we call it, the profit before interest and tax. I told you about that. If you pick the profit after tax and you are adding back interest, the interest should be post-tax. All right, so be careful. All right, be careful about that. In the question that we did, what did we do? So you have something like profit after tax. So you pick your profit. If you pick the profit before interest and tax, so you have a choice. So you can, it's profit. If you pick the profit before interest and tax, what figure have you picked? I showed you here. If you start with the profit before interest and tax, this is it. If you start with this one, you are going back to add the issues of things that are here. So when it comes to the interest, you don't do post-tax of the interest, all right? So basically that is that. But my advice, you have picked your profit after tax. So as per the question, you pick your profit after tax. Have you seen that? All right. So you are going to adjust it from the issues that are happening here. All right. So that is the issues that are happening here. So what are the issues that are happening here? If you pick that figure, you are going to add back depreciation because that is that. Please, what depreciation are you adding back? So you add back accounting depreciation. Then you less what? Economic depreciation. In the question that we saw, it was the same. So if you add deduct, we didn't bother even doing it. All right. So basically that is that. So you did that. Then you also have to deal with provisions. I think I've told you here. Okay, so the provisions. I told you here to also adjust for provisions. Where is it? Where is it? Also adjust for provisions. So you saw over there in the balance sheet, capital employed, we adjust for what? the opening provision, the opening balance, so the closing for last year, the opening for that one. All right, and here too you adjust for provisions. Okay, you also have to adjust for provisions. So what provisions are we talking about here? Which provision goes to your expense? If you remember your accounting, increase and decrease in provisions. So those are the things you are going to use to adjust. Okay, so you are going to also deal with increase. So you add back increase in provisions, especially provision for bad debt. So add it back. All right, but you will less what? Decrease in provisions. Why? Because increase in provision is treated as an expense and the decrease is treated as an income. All right, so that is that. So take note of that. Okay, so basically that is what you are going to do. All right, so deal with that. Again, the next thing that you are going to work on to also deal with it is, if you saw in the question, was the lease, the one that we did right now. If you saw, it is the lease. You are going to also deal with the lease. All right. Was it research and development? Sorry, you are going to deal with the research and development and non-cash item. All right, research. But you see, even the lease, there are lease rentals. Lease rentals. All right, those things are just like the interest cost. When you are adjusting them, you have to do the tax deductibility of those things. All right, if it is operating lease. Okay, so if you have lease rentals, okay, you get the difference between the lease itself and the lease rentals. All right, so basically that is that. All right, so be careful how these things happen. Okay, so you saw non-cash item, research and development, interest cost. So those are the things that you are going to deal with that. Okay, so here, research and development. So you are going to add back, all right, research and development. Because according to IAS 38, research and development are assets. They are not expenses. All right, so that is that. You are going to add that one back. All right, you are going to also add back non-cash items. Non-cash items actually include depreciation and amortizations. All right, so that is that. So, ladies and gentlemen, these are the things that you are going to deal with. So, but I've told you that if you have lease rentals, okay, so the lease rentals, it must be post-tax. Post-tax. This is coming from operating leases. Okay, so that is that. You have to add back that one too. All right, so post-tax, and lastly, you saw what we were doing, the interest, finance cost, interest, or finance cost. That one too is coming in the form of what? Post-tax. So 1 minus T, post-tax. All right, so this is how you get your NOPAT, adjusted NOPAT. Look at the items well so that when you face it in any examination, you should be able to deal with it. All right, you should be able to deal with it. So you have seen this size, and so when we go into part 3 of our video, we will just look at a past question and deal with it. All right, and you will get the vibe, and we go to how to deal with transfer pricing. So don't miss out on the next video. Take care, be ready, and bye-bye.